this section, we bring our focus to a particular company. Right? In particular, we want to understand the financial statements of this company. Now, if you think about a company, right, the company needs capital. The capital that the company has comes largely from two sources. One is the debt capital, right? So debt capital means that the company take a loan from the bank, or the company may issue a bond to investors, right? So the debt means it's simply an IOU, right? That in future the company promises to pay a certain coupon, right? And on the maturity of the bond, pays you back the principal. Another source of capital for the company might be share capital, right? So the company can issue shares to raise funds from shareholders. In some cases, the company may also issue hybrid securities such as convertible bonds, right? So convertible bonds behave like bonds, except that the investor, right, can bring the bond back to the company to convert into shares. So convertible bonds have characteristics of both debt and equity. All right, so when the company issues these securities, right, bonds and shares and so forth, for the investors might perhaps consider, right, investing in these securities. In order to invest in the company's securities, I think it is very practical to first find out more about the company, right? Is the company doing well? Is it having a very profitable business, right? So you want to know the operating and financial health of the company. And also you want to know, right, how the company is positioned within the particular sector or industry, right? So you need to get information. And a good source of information comes from the financial statements that company routinely issues. When it comes to financial statements, there are largely three main financial statements that the company issues, right? The first one is income statement. The income statement essentially is a profit or loss statement, right? It tells you how much profits or losses the company made for this accounting period. The next financial statement the company issues is the balance sheet. The balance sheet tells the investor what assets the company owns and how those assets are financed. Another financial statement the company routinely provides is this cash flow statement. Right? Cash flow statement essentially tells you how much is the movement of cash within the company for this accounting period. Right? And movement of cash can be due to three types of activity. Number one, the normal business of the company. Right? So from normal business of the company, typically the company earns cash. Cash movements can also come from investment. Right? If the company invests in a factory, the company buys a laptop, so that's money going up. Or if the company sells an asset, that's money coming in. Right? So the second set of activities that affects cash flow is investing activities. And the last one is financing. Right? The company can issue a bond to raise cash, right? Or perhaps to repay a loan, then cash goes out. Or the company can issue more shares, or the company can buy back the shares. Right? So that results in the cash moving in the company. These days, the companies also provide you another financial statements that tells you how much the equity has changed, right? And due to what reason. So this is the changes in equity statement, right? It tells you if the company has issued any new shares, at what price, or the company buys back some shares, right? So our focus will be on the first three financial statements. All right, this slide shows us the P&L statement or income statement for a fictitious company, WB company, right? So at the top line there, you see the net sales or revenue, right? So this is the top line. These numbers are in millions of US dollar. So this year, the company made a sale of $20 billion, right? In order to make this sales, right, you're selling goods and so forth. So to make these goods, you may incur, right, costs for the raw materials and so forth, right? So the cost of goods sold is 8.5 billion. So that gives you a gross profit, 11.5 billion. And then there are other costs that you cannot attribute to a particular product, right, or the unit of service that you sold. So these are the general or admin costs, right? So general and admin cost is 8.75 billion. So the operating income for this company is 2.75 billion. In some cases, this operating income is known as so-called the EBIT, right? EBIT is earnings before interest and taxes. So at this level, right, we have not taken out the interest costs and we have not taken out the taxes, right? So this EBIT sum of money can be given to providers of debt capital as well as equity capital. Now, this company typically would have some debt instruments, right? So need to pay interest. So the company pays an interest of 450 million. So therefore, the profit before tax is $2.3 billion, right? And the taxman is quite happy with this company because when the company makes a profit, the taxman will collect the income tax from the company, right? So the tax there is 500 million. So that leaves a post-tax income of 1.8 billion for the equity shareholders. This company doesn't have any preference shares, so all this $1.8 billion will be the net income or profit to the shareholders. Now, this slide shows us the balance sheet of this company. On the left-hand side, we see the listing for the assets. On the right-hand side, we see the listings for the liabilities. Now, when you look at the balance sheet, right, always remember the balance sheet is a true representation of the company's assets and liabilities only on balance sheet date. The balance sheet date for this company is 31st December. So on 31st December 2017, this is how the company looks. So on the left-hand side, we have assets. So typically, we start with the most liquid assets. The most liquid assets are the cash and cash equivalent. That is the 2 billion, right? Accounts receivables are what clients owe the company. So the company have to kind of collect on this accounts receivable as quickly as they can, right? Inventories are the products that they may have in the warehouse or the factory floors. And hopefully in the next accounting period, right, you turn all the inventories into cash. They might have some prepaid expenses, such as the rent that they pay for the whole year, right? So the total current assets for this company is 12.75 billion. So these are the current assets which the company thinks they can convert into cash in the next accounting period. There are other assets the company owns that may be used over a longer period, right? Things like the factory, right? Or the equipment that may be used for several years. So the property, plant and equipment is worth 3 billion, right, on the books. But over time, these machines get worn out and so forth. So the machines are now worth less by the depreciated amount of 1 billion, right? So the net fixed asset for this company is 2 billion. So if you add up all the assets of this company, the company has assets of $14.75 billion. Now, whatever the assets the company has, it has to be financed by liabilities and equity, right? So the right-hand side tells us how they are financed. Number one, the company owes $2 billion to its suppliers, right? So these are the accounts payable. Suppliers have supplied them with raw material, but they have not paid yet. So that's to the tune of 2 billion. All the accrued expenses, 950 million, right? So the current liabilities, 2.95 billion. So typically, we compare, right, the current assets versus the current liabilities to kind of give us some sense of whether this company is likely to run into liquidity problems in the near term, right? So in this case, the current assets are quite large compared to the liabilities. So maybe solvency or liquidity may not be an issue for this company. All right. Now, they also have long-term debt of $5 billion, right, and equity of 6.8 billion. The equity of 6.8 billion comprises of share capital of 5 that is contributed by the shareholders. And over time, when the company makes profit for the year, it may not distribute all the profit in the form of dividend. So it has retained earnings of 1.8 billion. Right? So if you add up the liabilities add up to be exactly 14.75 billion, which is the same as the assets on the left-hand side. Right? So this tells you the assets and liabilities the company owns. Now, when we read the financial statements of the company, we need to exercise a good dose of skepticism and care. all right? Because the quality of the data is quite important, right? And there are also the cases where you may not really understand, right? That particular number. So in that case, you should seek clarifications from the company. There are also other factors that you need to consider, such as the overall economic environment, right? Or the political environment of that particular country, or the social conditions, because that might also affect the future of that company, right? The management track record, right? Ability to execute strategy, right? The corporate strategy, and also how good they are in terms of improving their service or innovation, right? The competitive position of the company in the industry, right? Whether there's any threat coming from regulatory changes. An example would be, if you think about the banking industry today, right? Compared to pre-crisis, you see that now the regulators typically require banks to put up more capital versus the business that they do. So as a result, you see that the return on equity will not be as good compared to the times before the credit crisis, right? And certainly change of technology can affect a company, right? So these days, the company that makes the typewriters, they're all gone because everybody uses the laptops, right, and the desktop these days. And also to think about the sources of revenue for the company, and also any brand value. Right, there are many potential warning signs that you can look for, right, as you go through the financial statements of this company. For example, if you realize that, oh, the auditors are very concerned about the weak accounting disclosure, or as an investor, right, the company doesn't provide you sufficient information, right, or they are substantial related party transactions, right, or the management compensation structure is not in line with the sector or the industrial practice, right? So that the incentive for the management and the shareholders may not be aligned. Or if there's a lot of turnover of the staff, that's also a concern for you, right? Especially senior management, right? Leaving, right? Or board of directors changing and so on. Yeah. Or if they have a frequent dispute, right? With supporting professionals, such as that their auditors, their lawyers, their bankers. So that's also a red flag or warning sign. Or if they have a violation of regulations, right, or late filings of their financial statements, right, that's also something that investors should take note of, right, or some significant non-audit services performed by external auditors, or the declining market share, and so forth. Right. So in general, it is not a very trivial task to do corporate analysis. Besides the red flags that we discussed in the previous slide, there are also some potential problems with earnings quality, as we can see on this screen here, right?